If you turned 65 this year, or if you turned 65 at any point in the last several years, I need you to stay with me for the next 3 minutes before you pay another bill. Because there is a very good chance you're still paying at least one bill every month that the law says you do not owe. Not because you did anything wrong, not because you missed an application, because nobody called you on your birthday to explain that the rules changed. The bill keeps arriving, you keep paying it, and the money keeps leaving your account for something you were never legally required to pay after the age of 65. I am going to show you exactly which 6 bills those are, exactly how much each one is worth in real dollars, and exactly what you do right now to stop paying them. There are 6 bills sitting in the mailbox or the inbox of the average American retiree right now that the law does not require them to pay. Not 6 complicated financial products. Not 6 programs you have to navigate a government website to find. 6 bills. Bills you're probably paying right now. Bills that arrive every month or every year with the same due date and the same amount and the same assumption that your money is owed. And the reason you are still paying them is not that you failed to qualify for an exemption. It is that nobody who collects that money from you has any financial incentive to tell you the exemption exists. Your county does not call you on your 65th birthday to tell you they will freeze your property taxes. The Social Security Administration does not remind you that you can adjust the tax being withheld from your check. The utility company does not send a letter explaining that a state program will cover a portion of your heating and cooling bill. The tax preparation chain does not lead with the fact that you may legally qualify to have your return prepared for free by people the IRS itself has trained. The people collecting these bills are in the business of collecting these bills. They have no incentive to tell you when you no longer have to pay, and that is the entire reason this video exists. In the next 25 minutes, I'm going to walk you through all 6 of them, one at a time, in plain English. I am going to tell you exactly who each one applies to, exactly what the dollar value is, and exactly what you do right now to stop paying it. And then I am going to add 3 bonus moves at the end for the retiree who has built up some assets, because those last 3 can be worth more than everything else on this list combined, and the people who need to hear about them the most almost never do. Here is the one idea that connects all 6 of these bills. Being legally exempt from a bill and actually not paying it are 2 completely different things. The law does not refund you automatically. Nobody mails you a check when you turn 65. You have to know the rule exists and you have to act on it. That is the entire reason this video exists. My name is Steele. I am an enrolled agent licensed by the federal government to represent taxpayers directly in front of the Internal Revenue Service. I sit across the table from the IRS on behalf of real people every week. And the single most painful pattern I see over and over again is not people who cheat. It is honest, careful retirees at every income level paying bills they were never required to pay, year after year, simply because no one ever explained the rule. There is no penalty notice for this mistake. There is no alert. There is just money quietly leaving your account every month that never had to. So let us stop that right now. 6 bills plus 3 bonus moves. Stay to the end, because the last one is the one that quietly costs the most people the most money and is one of the simplest of all to stop. Let us start with the one that is brand new, that most retirees do not know exists yet, and that has a deadline attached to it that makes it urgent. Bill number 1 is your federal income tax. And I need you to really hear this, because for millions of seniors, the correct amount of federal income tax they owe going forward is dramatically lower than what they are currently paying. And for a significant number of them, it is 0. Many of them are still paying it or still having it withheld from their Social Security check and their IRA distributions, entirely out of habit and the fear of owing something at tax time. Here's what changed. In 2025, Congress passed a law called the One Big Beautiful Bill Act. Buried inside that law is a new deduction specifically for every American taxpayer who is 65 or older. It is $6,000 per person. If you are married and both of you are 65 or older, it is $12,000. And the reason it is so powerful is that it stacks on top of everything you already receive. It sits on top of your regular standard deduction. It sits on top of the existing extra standard deduction that seniors have always been entitled to for being over 65. You do not have to itemize to claim it. You do not give up anything else to get it. It is simply added on. Now, here is who this helps, and the answer covers both groups. If you are a lower income retiree living primarily on Social Security with a small pension or a modest IRA withdrawal, stacking these deductions on top of each other very likely pushes your federal income tax all the way to 0. The IRS itself confirmed in April of 2026 that a 72-year-old individual filer with income of $70,000 can now claim a total of $23,750 in combined deductions under the new law. For a retiree with modest income, that level of deduction means no federal income tax owed at all. If you are a comfortable middle-class retiree, you're not left out either. The deduction is available in full to single filers with income up to $75,000 and to married couples with income up to $150,000. It only begins to phase out above those numbers and does not fully disappear until income exceeds $175,000 for a single filer or $250,000 for a married couple. The only retirees this truly leaves out are those at the very top of the income scale. Everyone else gets real money. A married couple in the 22% tax bracket with combined income comfortably within the threshold receives a $12,000 new deduction. That is $2,640 back in their pocket every year, without doing anything differently, without changing any investment or any income source, simply by claiming a deduction that exists in the law right now. And one more thing you need to know, because it makes this urgent. This deduction is temporary. The senior bonus deduction exists for tax years 2025, 2026, 2027, and 2028. 4 years, unless Congress extends it, which means every year you do not claim it is a year you cannot recover. If you use tax software, verify it is being applied. If someone prepares your return, ask them directly whether they applied the senior bonus deduction from the One Big Beautiful Bill Act. If they do not know what you are referring to, find someone who does. That is bill number 1. Bill number 2 is the tax on your Social Security benefits. And I want to spend real time on this one because there is a specific mistake happening right now that is costing retirees real money every single month from a decision they made years ago and never revisited. Here is the background. Whether your Social Security benefit is taxable depends on something called your provisional income, which is your adjusted gross income plus any tax-exempt interest you earned plus half of your Social Security benefit for the year. If you are single and that number comes in under $25,000, 0% of your Social Security is taxable. If you are married and it comes in under $32,000, same result. And as your income rises above those thresholds, up to 50% and then up to 85% of the benefit can be counted as taxable income. The new senior bonus deduction directly reduces your adjusted gross income by $6,000, which means it directly reduces your provisional income by $6,000, which means it directly reduces how much of your Social Security is counted as taxable. For many retirees who were sitting just above the threshold where 50% of their benefit was taxable, the new deduction pulls them back below it. Their Social Security taxation drops from 50% to 0. But here is the specific mistake that is costing people money right now. When people file for Social Security, many of them fill out a form called the W-4V. That form instructs the Social Security Administration to withhold a flat percentage of the monthly benefit for federal income tax. 7%, 10%, 12%, or 22%. Most people who filled it out chose 10 or 12% to be safe and have never looked at it since. The withholding is a flat percentage of the gross benefit. It has no relationship to the actual tax liability. It does not know about the senior bonus deduction. It does not know whether the new deduction has pushed the taxable portion of the benefit to 0. It just takes the percentage that was chosen, in some cases years ago, and removes it from every single check. For many retirees who now owe 0 federal income tax on their Social Security, 10 or 12% is still being withheld every month. That money comes back as a tax refund in April. But in the meantime, the government has held it for 12 months at 0% interest while the retiree operated on a monthly budget that was smaller than it needed to be. The fix takes 15 minutes. Look at your actual tax liability on your Social Security based on your full current income picture, including the new deduction. If you owe nothing, file a new W-4V to stop the withholding entirely. If you owe a smaller amount, adjust down to 7%. The form is at ssa.gov. Every month of unnecessary withholding is a month of your own money being held by the government for free. That is bill number 2. Bill number 3 is your property tax. And this is the one that makes retirees the most genuinely angry when they find out what was available to them. Because this is the one where the assumption that the program is not for someone in their situation has cost the most people the most money for the longest period of time. I want to be precise about this because there are actually 3 distinct types of senior property tax relief. And between them, they cover almost every homeowner over 65, regardless of income level. The first type is the income-based exemption, often called a circuit breaker, aimed at lower and fixed income seniors. These programs can knock a significant portion of assessed value off your property tax bill, depending on your income and your state's specific rules. The second type is the flat senior exemption that reduces a set amount from the assessed value of the home regardless of income. In Texas, for example, homeowners over 65 automatically receive an additional $10,000 school district exemption on top of the standard homestead exemption. Many local taxing units add their own senior exemptions on top of that, with combined reductions commonly exceeding $60,000 in assessed value in many Texas counties. The third type is the age-based freeze, and this is the one that comfortable middle-class retirees consistently assume does not apply to them because they assume their income is too high. But many freezes have no income test at all. In Texas, once you turn 65, your school district property taxes are frozen at the level you paid the year you turned 65. Your home value can double, your neighborhood can transform, your frozen school tax does not go up. No income limit, you qualify because of your age. In Cook County, Illinois, the Senior Freeze Program locks your equalized assessed value if your household income is under $75,000. New York recently expanded its senior citizens exemption, with localities now allowed to offer eligible senior homeowners exemptions of up to 65% of their home's assessed value. Florida freezes your property tax assessment at the value it was when you qualified, meaning even if property values in your area double, your taxes do not go up. And here is the number that makes this the most frustrating item on the entire list. According to AARP, only about 8% of the more than 9 million seniors who are eligible for property tax relief in the United States actually apply for it. 8%. 92% of eligible senior homeowners are paying a bill they do not have to pay in full because nobody told them the program existed, or they assumed they did not qualify. Here is why your county will never call you about this. Every dollar of relief you claim is a dollar of revenue the county loses. They have no financial incentive to proactively identify you as a qualifying senior and reduce your bill automatically. In most states, the exemption is not automatic. You have to file. And almost every one of these programs has a hard deadline, typically in the spring. And if you miss it, you pay the full bill for that year and wait until next year to try again. The fix is one phone call. Call your county assessor's office and ask 2 specific questions. What senior property tax exemptions, freezes, and reductions do you offer for homeowners over 65? And which of those programs are based on age alone with no income limit? That conversation has been worth hundreds to thousands of dollars per year to retirees I have worked with at every income level. That is bill number 3. Bill number 4 is your Medicare Part A premium. And this one applies to a specific group of retirees who are paying a bill they were never supposed to pay and may not even realize they are paying it. Medicare. Part A is the portion of Medicare that covers hospital stays, skilled nursing facility care, hospice care, and certain home health care. For the vast majority of Americans, Medicare Part A is completely free. If you or your spouse worked and paid Medicare taxes for at least 40 quarters, which is 10 years, you owe $0 in Part A premiums. 0. The work you did during your career already paid for it. But some retirees are paying a Part A premium. In 2026, the Part A premium for someone with fewer than 30 quarters of Medicare-covered work is $518 per month. For someone with between 30 and 39 quarters, it is $285 per month. And here is how seniors end up paying this without realizing they should not have to. Some retirees spent part of their career in jobs that did not pay into Medicare, such as certain government positions, and part of their career in jobs that did. The Social Security Administration determines their Medicare eligibility based on the combined quarters of covered employment. If the calculation is done incorrectly, or if employment history is incomplete or inaccurate in the SSA's records, a retiree may be enrolled in a premium-paying version of Part A when they actually have the work history to qualify for the free version. If you are currently paying a monthly Medicare Part A premium, and if you believe you worked and paid Medicare taxes for at least 10 years across your entire career, including time at multiple employers, contact the Social Security Administration and ask them to verify your Medicare-covered quarters of employment. Provide whatever employment records you have. If the record is corrected and you're found to qualify for premium-free Part A, your monthly bill drops to 0 and you may be entitled to a refund of premiums paid while the error was in place. For the lower-income retiree who genuinely has fewer than 40 quarters of Medicare-covered work, the Medicare Savings Program may cover the Part A premium entirely. The Qualified Medicare Beneficiary Program, which I have covered in detail in previous videos, pays Part A premiums, Part B premiums, deductibles, and co-insurance for qualifying low-income Medicare enrollees. If your monthly income is at or below approximately $1,260. As a single person, you likely qualify for the QMB program and should not be paying any Medicare premium at all. That is bill number 4. Bill number 5 is your utility bill. And this one surprises people at both ends of the income spectrum because the income thresholds are higher than most people assume, and the programs available in many states extend far beyond what the federal program alone covers. The Low-Income Home Energy Assistance Program, known as LEHEAP, is a federally funded program that provides direct assistance to households for heating and cooling costs. The assistance can come as a payment directly to your utility provider, reducing your bill, or in some cases, as a direct payment to you. The federal income thresholds allow states to set eligibility at up to 60% of the state median income, and many states use additional state funding to extend the program further. In many states, a single senior with income approaching $24,000 or a couple approaching $35,000 can qualify for meaningful assistance. But the federal program is only part of the picture. Most states have their own additional utility assistance programs specifically for seniors, some of which have income thresholds significantly higher than the federal LIHEAP limits. Several states have senior-specific programs with no income test at all, providing reduced utility rates or credits simply based on age. At the city and county level, the programs become even more varied. The city of Los Angeles, for example, has a utility users tax exemption specifically for seniors and disabled residents that exempts qualifying households from paying the city's utility users tax on electric, gas, water, and telephone service. The income threshold for that exemption is $60,600 for the prior calendar year, which covers a broad range of senior households. Similar city-level utility exemptions exist in major cities across the country. Additionally, every major utility company operating in the United States is required to offer low-income assistance programs as a condition of their operating licenses in most states. These programs go by different names at different utilities, often called CARE, FARA, or similar acronyms depending on the state, and they provide ongoing percentage discounts on monthly utility bills for qualifying households. The income thresholds for these utility company programs are separate from and often more generous than the LIHEAP thresholds. Here is the number that illustrates the scale of this opportunity. The average LIHEAP benefit nationally is approximately $500 to $900 per year. Combined with state supplements and utility company assistance programs, a qualifying senior can reduce their annual utility costs by $1,000 to $2,000 or more in many cases. The application is typically handled through your state's LIHEAP administrator, which you can find at acf.gov or by calling 211, which is the National Social Services referral line. And for the comfortable retiree who assumes their income is too high for any utility assistance program, a single phone call to 211 to ask what programs exist for seniors in your specific county takes 5 minutes and costs nothing. The answer might surprise you. That is bill number 5. Bill number 6 is the one that is going to feel personal because it is the fee you pay every year just to deal with all the others. Bill number 6 is your tax preparation fee. Every year, millions of seniors walk into a national tax preparation chain, sit down with a preparer who charges $250 to $500 for a return that often involves little more than entering Social Security income, a pension, a few IRA distributions, and some investment statements, and walk out having paid that fee because they assumed this was what tax preparation cost, and they had no alternative. Many of those people legally qualify to have that exact same return prepared for free by people the IRS itself has trained and certified through programs funded specifically so that qualified seniors never have to pay for tax preparation. The Tax Counseling for the Elderly program, called TCE, is an IRS-funded program for people 60 and older that specializes in exactly the tax questions retirees have. Pensions, Social Security, retirement account withdrawals, the new senior bonus deduction, all of it. The largest provider of TCE sites is AARP Tax Aid, which operates thousands of free tax preparation sites across the country. You do not have to be an AARP member. You do not have to meet any income requirement beyond being 60 or older and having a tax situation that the volunteer preparers are qualified to handle. In 2025, AARP Tax Aid helped more than 2 million people file their returns for free. The Volunteer Income Tax Assistance Program, called VITA, has a broader income limit, generally up to $67,000 in household income, and also provides free certified tax preparation. Both programs are funded by the IRS and use preparers who are trained and certified in federal tax law. They are not a lesser alternative to a paid preparer. They are a free alternative to a paid preparer, backed by federal certification and specifically designed for exactly the kind of return most retirees file. I am an enrolled agent. My work is in tax representation, which means I earn my living from tax professionals being valuable to clients. I'm telling you that a retiree with a standard retirement income situation, Social Security, a pension, IRA distributions, and perhaps some investment statements, should not assume they have to pay $300 to $500 for data entry at a national tax chain. The law has built you a free, qualified, federally certified alternative, and your age makes you eligible for it regardless of whether you are struggling financially or doing just fine. To find a TCE or VITA site near you, go to IRS.gov and use the VITA locator tool or search for AARP tax aid plus your city or zip code. Many locations require an appointment and open in February, so planning ahead matters. But for most retirees who have been paying for basic tax preparation for years, finding out this option exists is the equivalent of discovering a bill they never owed. That is bill number 6. Now, I promised you 3 bonus moves, and I want to be direct about who they are specifically for. The 6 bills I just covered reach across every income level in different ways. These bonus moves are specifically for the retiree who has built up some assets, a home that has appreciated significantly, investments in a taxable brokerage account, charitable giving as a regular part of life. If that is not your situation right now, the first 6 bills already have you covered and you can hold here. But if you have built something, these 3 can be worth more than everything else I just described combined, and almost nobody in the financial media explains them clearly to ordinary people. Bonus, move number 1, is the federal income tax on selling your home. And the reason I include it is that fear of this tax is keeping more retirees in situations they do not want to be in than almost any other financial misunderstanding I encounter in this work. Here is the fear that lives in millions of retirees' heads. You bought your house decades ago for $80,000 or $90,000. Today, it is worth $450,000 or $500,000. And you're certain that if you sell it, the government will take a significant percentage of that enormous gain. So you stay in a house that is too big, too expensive to maintain, too far from your children, or simply not where you want to spend the next 20 years. You stay because of a tax you believe is coming. In many cases, that tax is not coming. The home sale exclusion is a rule in the federal tax code that allows you to exclude up to $250,000 of gain from the sale of your primary residence from federal taxes if you are single, and up to $500,000 if you are married and file jointly, as long as you have lived in the home as your primary residence for at least 2 of the last 5 years. The gain is the sale price minus your original purchase price, minus the documented cost of improvements you made over the years. A married couple who bought their home for $100,000 and is selling it for $500,000 has a gain of $400,000. The exclusion is $500,000. Their federal tax on that sale is 0. They have been staying in a house they no longer want, afraid of a tax bill that was never coming. That misunderstanding is not a small inconvenience. It is a life decision made on false premises. The timing caveat is real and important. If you have moved out of your home for any reason, the 2-year residency clock is running. Every month you are not living in the house as your primary residence is a month that does not count. If you have been away for more than 3 years, the exclusion may be gone. Check your timeline carefully before making any decision about selling. That is bonus move number 1. Bonus move number 2 is the 0% federal capital gains tax rate for the retiree who has appreciated investments in a regular taxable brokerage account and who is in the income window where this rate applies. When your taxable income falls below a certain threshold, after all deductions are applied, the federal tax rate on long-term capital gains is 0%. In 2026, that threshold is approximately $48,350 for a single filer and $96,700 for a married couple, taxable income after deductions, including the new $6,000 senior bonus deduction. For a retiree in the years between retirement and when required minimum distributions begin, their income is often at its lowest point in their adult life. Social Security, a pension. No IRA distributions yet because they have not started. In those years, after the standard deduction, the senior extra deduction, and the new senior bonus deduction are all applied, their taxable income may fall below the 0% capital gains threshold. If they have appreciated investments in a taxable account, stocks or funds that have grown in value over the years, they can sell those positions in that low income year and pay 0 federal tax on the gain. Not deferred, not reduced, 0. The gain is recognized, the tax is 0. The same retiree who waits until required minimum distributions force their income higher may pay 15% on the identical gain. Same investment, same amount, same appreciation, different year. Thousands of dollars of difference from timing alone. The move is to look at your taxable income picture every year before December 31st and ask whether there are appreciated positions in a taxable account worth harvesting while the rate is 0. This is not complicated. It is not available only to the wealthy. It is available to any retiree whose income falls below the threshold in a given year and who has appreciated investments they can choose to sell. That is bonus move number 2. Bonus move number 3 is for anyone who is 70 and a half or older, gives to charity, and has money in a traditional IRA. I have covered this before, and I will keep covering it because it is one of the most powerful tools available to a retiree and one of the most consistently underused. It is called the qualified charitable distribution. Once you are 70 and a half, you can direct money from your traditional IRA directly to a qualifying charity, up to $111,000 per person in 2026. That money is completely excluded from your taxable income. Not deducted from income. Excluded. It never appears in the calculation at all. Most retirees who give to charity write a check from their bank account. They get no tax benefit because they take the standard deduction. The money leaves their bank account. Their taxable income stays the same. The QCD changes the entire picture. The money leaves the IRA and goes to the charity directly. Your IRA balance decreases. Your required minimum distribution obligation decreases. And the money never appears in your adjusted gross income, which means it never appears in your provisional income for Social Security taxation, never appears in the income calculation that determines your Medicare premium surcharge, and never interacts with any other income-based threshold in the tax code. A retiree who gives $10,000 a year to their church and does it through a QCD rather than a bank account check is giving the same amount to the same cause. The charity receives the same money. The only difference is where the check comes from, but the tax impact is entirely different. At a 22% bracket, routing $10,000 of charitable giving through a QCD rather than a bank account saves $2,200 in federal income taxes in a single year. Every year, for as long as they continue giving. If you are 70 and a half or older, give to charity in any amount, and have money in a traditional IRA, and you're not using the qualified charitable distribution, you are paying taxes you do not need to pay. The instruction to your IRA custodian to direct charitable giving as a QCD rather than a regular distribution takes one conversation. It does not cost anything to set up. And the benefit accrues every year from the first year you implement it. Let me close with the one idea that ties everything on this list together, because it is more important than any specific bill or any specific exemption. Every one of these bills is being paid right now by retirees who do not need to pay it. The property tax is going to counties that have programs on the books, specifically to reduce or freeze senior bills that nobody told them to apply for. The federal income tax is being withheld from Social Security checks at rates set years ago without accounting for a deduction that now makes much of that withholding unnecessary. The utility bills are arriving in full when state and local programs exist specifically to reduce them. The Medicare Part A premium is being paid by people whose work history entitles them to have it covered. The tax preparation fee is being charged to people who qualify for free, certified preparation funded by the IRS itself. None of these exemptions are automatic, not a single one. The law creates the exemption. It does not enforce it on your behalf. It does not notify you when you qualify. It does not follow up when you do not claim it. The money stays where it is, going from your account to whoever is collecting the bill indefinitely, until you stand up and claim what the law already says you're entitled to. Being legally exempt is worth nothing until you actually act on it. That is the entire game. And it does not matter whether your income is modest or comfortable. There is something on this list that is overcharging you right now. Before I close, I want to give you something to take with you. I put together a free checklist, my 2026 Senior Exemptions and Bill Reduction Checklist. It walks through every bill I described today with the specific eligibility criteria for each, the form or phone number to use to claim the exemption, the income thresholds for each program so you know exactly where you stand, the deadline for property tax applications in each state, the VITA and AARP tax aid site locator instructions, and the 3 bonus moves with the specific income thresholds and IRA instructions. Every item includes what to do and exactly where to do it. To get it, go to marcusgravestacks.com/checklist. The link is also in the description below. Print it out, go through it before you pay another bill from this list. And go through it again in the fall before property tax deadlines close and before Medicare open enrollment begins. Here is what I want to leave you with. The people collecting these bills are counting on one thing. Not that you are dishonest, not that you're careless. They are counting on the fact that you assume the bill is correct because it arrived, that you assume the exemption is for someone else, that the lower income senior assumes the good programs are only for people who are really struggling, that the comfortable senior assumes the relief is only for people at the bottom. Both of them keep paying. That is the whole system. And the moment you know these 6 exemptions exist and know they apply to you, regardless of where you sit on the income scale, the bill changes. Not automatically, but it changes. You now know all 6. You know the 3 bonus moves. And you know that knowing is only the first half of it. The second half is the phone call to the county assessor, the new W-4V to adjust your withholding, the appointment at the AARP tax aid site, the call to 211 about utility assistance, the form that changes your IRA charitable distribution to a QCD. Do one more thing before you close this video. Send it to one person in your life who is over 65, a parent, a neighbor, a friend from church, a sibling. It does not matter whether they are getting by on a fixed income or sitting on a paid-off house with a pension. The odds are very good that they are overpaying at least one of these bills right now. And one share from you today could be worth more to them than any gift you have given them in years. That is what this channel is here to do. I will see you in the next one.